Hey there, you guys. Before we jump into today's video, I just wanted to take a moment and to remind you that as a big thank you for hitting the 400,000 subscriber on my channel recently, I'm hosting a huge giveaway happening right now. So to find out how you could win up to a $250 gift card, a free ticket to my virtual workshop, and other really great prizes, just click the link in the description of this video to enter my 400,000 YouTube subscriber giveaway. So enter today. Now back to the video. Hi, you guys. I'm Phil Town from Rule 1 Investing, and today I want to talk to you about whether or not I think there's going to be another housing crash. So as you may know, the housing market seems to be booming right now. We've got record low mortgage rates still, even post-pandemic. But could this amazing surge in housing prices be faced with a bust that could be coming up in the near future? And that's what I'm going to talk about today. So let's get started. All right, first off, housing crash, the last one we had, happened in 2007, 2008. And it came about because we had record low mortgage rates for back then, which encouraged people to buy homes. They became more affordable because, of course, your mortgage rate determines how much you are going to pay every month. As mortgage rates go down, for every $100,000 that you're borrowing, your monthly payment goes down substantially. If interest rates are at 7% or 8%, or I think I bought my first house when interest rates were at 12%, then you can afford X amount of house, right? Because you can only afford so much per month. Let's say you can afford a couple thousand a month. At 10% interest rates, you're not going to be able to get a big house. So a housing crash comes about in a couple of different ways. The typical crashes for any kind of an asset happen because the asset gets into a bubble. And what that means is there's a time when everybody starts to understand that you can make money in this asset, and people jump into it more and more, simply depending on somebody paying more for the asset than they paid. So that's typically what happens in a bubble. And a crash comes because eventually the bubble pops. They all seem to. So a housing crash is kind of unique because it doesn't happen very often, but we had one just, 10 years ago or so, 2008. We had a massive housing crash. That one came about because we had so many people buying houses to speculate. I don't know if you remember the Big Short, but great book and a great movie about the whole housing crash and about the bond market crashing as well. And in that story, there's a couple of guys who are interviewing strippers in Las Vegas, if you'll remember the movie. And these girls are saying how many houses they own. They own 6 houses, and all the other girls own 6 houses. And this guy is sitting there going like, how do you get a loan? And she says, it's really easy. You just go down and tell them how much money you're making every year. And you just make it up. You just make it up. And so what happened was so much money became available for housing that people were buying houses and speculating that the price would go up. And they were buying many, many, many houses. And when the price finally got to a point where it was absurd, then people stopped buying them. And when they did, a lot of these mortgage that people owned could not be paid. They didn't have the money to do it because they had made liar loans, because they had gotten more house than they could possibly afford. Whatever the reason, as soon as they had to start refinancing this with a different mortgage, then boom, we had a major crash. Now, unfortunately, that mortgage crash resulted in a freeze up of the credit of the entire country, and it started spreading around the world. So the Federal Reserve had to come in and take really aggressive action in order to unfreeze credit and get people paid. It was very near kicking us into a depression. So the housing crash in 2008, 2009 was just spectacular and incredibly damaging to the economy. So let's take a look at what's going on today. Do we have a bubble in housing, right? That's where we really need to start. Is housing cranking up a bubble? And if it is, how high can it go before it crashes? So a couple of things determine how far it can go. The first is, how aggressively are people buying houses and how much are they paying for them? And what kind of interest rate do they have on their mortgage? So right now, Housing prices have risen above where they were in 2007. So we can say pretty much we've got a pretty strong housing market. Number two, we have a really depressed, not depressed, it's not the right word. What we have is a real limitation on materials that was created by the pandemic. So when everybody went home, that meant everybody went home, including the people who make raw materials like lumber. So lumber is in shortage, steel's in shortage, all sorts of things are short that are needed for buildings. And now it's very difficult to get them, therefore the price goes up. And I think lumber is right now priced at something like 200 or 300% higher than it was before pre-pandemic, which means it's getting expensive out there to build a new house. And what that does, of course, is drive the price up of used houses as long as the interest rates stay low. And that is the other place where the market's being manipulated with. The interest rates have been kept artificially low by the Federal Reserve, aggressively going in and buying treasury notes, which basically set the interest rate for mortgages. So if they're going in every day, basically the federal government creating money to the tune of, I hope you're sitting down, they're now creating money to the tune of $120 billion a month, new money into the market, buying these treasury notes that the federal government then uses that money and spends it on all the government things we're doing these days. And the result is more and more money in the economy, more and more people getting more and more money. I'm sure you know people have gotten plenty of money just for free from the federal government. And this stimulates buying. And the kind of buying it stimulates is housing. So we've got this twofold effect. Number one, we've got a squeeze on materials driving housing prices up for new houses. And number two, we've got lower interest rates, which encourage people to go spend money while interest rates are low and they've got the money to spend because the federal government's paying it out there. Now, these are really cranking up housing. We just helped one of our kids buy a house up in Montana, and the house, I think one house they looked at a couple of years ago was selling for like $900,000. Today, it's on the market for $1.7 million. This is like 18 months later. So there's an incredible boom going on in some parts of the country, and everywhere they're experiencing a push on housing and a kind of a shortage on housing. So this is really pushing up the bubble of the housing prices. And the question is, will it pop? Now, there's another interesting factor that's going on here, guys, and that you need to know about, and that is the factor called inflation. That's a real interesting problem because the printing of money without wealth being created by it means that you've just devalued the actual buying power of the US dollar. Now, this is no new thing, right? This has been going on aggressively since 1934, when FDR first started massively devaluing the dollar for the first time in American history. And they have continued that devaluation process by printing more money than we are creating in wealth. And the result is right now that your dollars will buy about a nickel of what they bought in 1935. So that devaluation is continuing aggressively. And during Donald Trump's administration, the last year, they printed about $6 trillion. This year, they're printing another $2 trillion, as I said, every month, $120 billion. And then they're adding to that another $6 trillion that President Biden wants to spend. And the result, if all that spending goes through, will be just that would be, I mean, last year was unprecedented. This is going to be even more unprecedented. So the combination of the two administrations is rather earth-shaking. The question is, will inflation result from that? And what we're seeing already is food prices are going up maybe 2 or 3 times the stated rate of inflation. Energy prices are starting to rise again. Gasoline has just gone up 50% in many places. And we'll probably see more rises in the future. And of course, we know housing prices have gone up nationwide at 15% over the last year. And the funny thing about all this is that those numbers aren't even included in the Consumer Price Index, which is used by the federal government to determine if there's inflation. So the Federal Reserve, on one hand, is like the wise men who are handling our money supply, and on the other hand, they're like, see no evil, hear no evil, speak no evil about the potential of inflation. In fact, right now they're just saying inflation is coming, but it's temporary, so don't worry about it, as if they could say it's coming and it's permanent. You're never going to hear that from these guys. So we've got to kind of take it onto ourselves to understand what's inflation doing to these housing prices as well. So here's the problem. If inflation goes up, then the Federal Reserve may have to try to slow it down. And the only way the Federal Reserve has of the most effective way they have of slowing down inflation is to allow interest rates to rise. That could be a problem, right? I mean, we just said that's one of the two major factors in driving housing prices right now is low interest rates. So if the Federal Reserve, all they have to do to allow interest rates to rise is simply stop buying those bonds every month at $120 billion a month. If they do that, then the market will start pricing those bonds at higher and higher interest rates. The reason they're going to price it at higher interest rates is really simple. Everyone out there on the other side of the world is looking at the United States and seeing that we printed a ton of dollars, and that should result in inflation. And therefore, if I'm going to lend the government money, I don't want to get an interest rate of 0.6%. I don't want 1%. I don't want 2%. I want 5%. Give me 5% and I'll lend you money for 10 years. Now that is going, if that happens, it will drive up interest rates aggressively on the government treasury notes. And those are what are considered risk-free rates. You don't have to worry about getting paid back from the federal government. And as a result, mortgage rates, which are not considered risk-free, because you might buy the house and then not pay the rate, right? You may not pay your mortgage. So they're not risk-free, and they will have to go higher than the government treasury notes. And when that happens, you could see the bubble pop. I mean, you can see it coming, right? If they drive interest rates up, then the price people are paying right now when interest rates are at 3% for a house, if interest rates go to 6%, they're going to be able to pay about half as much for that house. And you're going to see a major problem in a lot of the housing markets out there. Now, there are some housing markets, I'm thinking of a place I lived for 20 years, Jackson Hole, for example, where when interest rates start to go up, the housing prices don't go anywhere because these are wealthy people with second homes and they can afford to sit on them and do nothing about changing their price. They can just say, no, I'm not going to take a lower price. But normal people have to go sell their house if they're moving. They have to sell their house if they need to get money out of it. They have to sell their house if they've speculated on it. And they are going to unload those houses. And that's what happened in 2007. So where am I at on this? First, I think there is an absolute bubble going. Second, real estate is one of the really good assets to own when there's inflation. So that argues to be in the housing market. But third, if they start raising interest rates to counter inflation, then housing prices are likely to stall out or even drop. So what am I doing? Well, I'll tell you, I'm betting that we're going to have the inflation. And I'm thinking that down the road, we're going to see rising housing prices continue. Now, I don't think they're going to rise as fast as they have during this pandemic, but I think you're going to see them continue, flatten out, continue as interest rates continue to stay low. I think the Federal Reserve will do everything in their power to prevent interest rates from rising, even if they have to continue dealing with inflation over the near term, which are maybe the next 2 to 3 or 5 years. So I think what we're going to end up with here is a housing market that's going to continue to go. We are actively looking at real estate now as an alternative to some of the things we're doing in the stock market. But by the way, the stock market's also one of the best, if not the best thing to be in during inflation. So real estate, yes. Stocks, even more so, respond to inflation. And, you know, at some point, the whole game stops, but I don't think it stops right here. And we'll see. All right, so now I'd love to hear from you guys. Do you guys think there's going to be another housing crash in the near future, or is the not so near future? What do you think? So leave a comment below with your answer. I'll be sure to follow up with you. And thanks for watching, you guys. Now go play. Hey, if you enjoyed this video and you feel it was valuable in teaching you more about whether or not I think there'll be another housing crash, hit the like button. Please share the video with your friends. If you want more investing content, subscribe to my channel, you guys. And don't forget to click the button on the screen for a free gift. Thanks again for watching.